So, good afternoon, everybody, and welcome to our Budget 2021, the Impact and Opportunities for Small Businesses webinar, presented today by Virish Paul. My name is Agnes Vizdenita, and I'm one of the client managers here at Paul & Co, and I will be your moderator today. We are using the Zoom platform today, and I will quickly go through some Zoom settings just for those of you that might be unfamiliar with the webinar environment. So you can select the audio settings here to select and test your speakers. You can submit any questions that you've got via Q&A button. We will answer any questions that you've got at the end of the webinar, but feel free to drop any questions here as we go along. You can, of course, leave the meeting at any time just by clicking this Leave Meeting button. Just to let you know, this webinar is being recorded, so we will be sending a copy of the recording and also the copy of the slides to everyone that has attended today. Now, I would like to introduce today's presenter, Virish Paul, the director and founder of Paul & Co. Chartered Accountants Limited. And Virish will be taking you through the webinar today. Hello, Virish.
Good afternoon, Agnes. Thank you very much for that introduction. And welcome to all of you who are attending this live webinar on the big event of this week, which was the budget. So today's subject is going to be just that, the budget 2021, which was meant to have a lot of surprises, and it did have surprises because whilst a lot of, as has become the pattern lately, a lot of the proposals that come up with the budgets start getting leaked out with the intention of preparing the public for what's going to come. This one was no different. We were being prepared for a lot of increases in taxation and lots of other bad news. But in the end, I think it worked because people were pleasantly surprised. In fact, what has happened is, I don't know if you read today's papers, but the budget appears to have given a big boost to the government in power, and people are generally very happy. And they're not bothered about the increases in taxation. And that's because of what I'm going to talk about, the fourth item on this list, which is the COVID-19 measures, because the government has, or the Chancellor has, come up with quite a few giveaways, which we're going to be either finishing very shortly and have been extended, and he's added a few other things. So that's what maybe softened the blow. Yes, people were expecting increases in taxation, and some of them have come, but it's not as if it's going to happen now. They've been like kicked down the road. The can's been kicked down the road for things to come up later. So I'll be talking about briefly about corporation tax changes, income tax changes, the VAT changes, and then I'll focus on the COVID-19 measures and maybe spend a little time on what has not changed, because a lot of things which were expected to change did not happen. So let's get on with it. The first item, as I said, is going to be the changes to the corporation tax rate. 25% was not what people were expecting. Everybody thought had been prepared for the corporation tax rate to go up. Now, the corporation tax rate has been coming down 1% at a time. And Osborne promised a few years ago that it will come down to 17%. Now it's stuck at 19%, and we would have expected to go down to 18%, but the brakes have been put on that because the corporation tax rate is not going to go down, not for a few years. So is it going up? And the surprising part, and the pleasant part, if you like, was that from this year, the year which is going to come in, April 21, there's no change, absolutely no change. And likewise for the next year. So all that hoo-ha about corporation tax rates going up has been delayed. For the next 2 years, up to the 31st of March 2023, there is going to be no change at all. We will carry on paying taxes at 19%. Yes, it's not going to go down to 18 and 17%, but 19% is what is going to be the corporation tax rate. So what's going to happen after that? From 1st of April 23, yes, there is a change. And the change is, what is the change? No change. No change for companies with profits of less than £50,000. That is now going to be called the small companies rate, the small profits rate, which will remain at 19%. So where has it changed? It has changed for the companies with larger profits. And that also only if, well, in the main, if your profits are over £250,000. When I say your profits, I mean the company's profits. The company's profits are more than £250,000. That is going to be the main rate of corporation tax effective from 1st of April 2023. So we're still fine at the moment. Even the big companies are only paying tax at 19% for the next 2 years. While the economy picks up steam, and when companies do start making more profits, they will expect us to pay more taxes, which is not surprising. But a few complications and changes which you need to be aware of. When the rate goes up to 250 to 25%, and that is a 6% jump. It's a huge jump from today's 19% to go up to 25%. It's a huge jump. Still, I'm told, I can tell you, it's less than the corporation tax rates in other countries. USA, for instance, is talking of putting up its rate to 28%. So 6% increase to 25% is not too bad. And then even if your profits are more than 50,000, you don't really get to pay 25% until you get to 250,000. And in between, there is that marginal rate from profits above 50,000, and before they get to 250,000, it gradually increases. And there's a complicated formula, which used to be the case, by the way, till about 5 years ago, when we did have something similar. And this is why I have been saying to people in the last few weeks that this is possibly what he's going to do. So what he has done is brought in a lower rate at 50,000. It used to be 300,000 in the past. All right, so we got 50,000 limit now, but there's a gradual increase. But there is one other sting in the tail here. And that sting is that the rate applies to a single company. If you have associated companies, then the 50,000 and the 250,000 limit gets reduced. So for instance, if you have two associate companies, the 50,000 rate limit becomes 25,000. Now that will get worrying, because there are a number of people who have a number of companies which are associated with each other. So what do we mean by associated companies? Very simply, it's companies under a common control. So if a husband and wife, for instance, have equal shares or similar ownership of 4 companies, 5 companies, that £50,000 limit gets reduced to 10,000. And then they start paying the higher rate tax. So, as I said, definitely a sting in the tail. Now, we got rid of associate company rules 5 years ago, but they're back, and they come back with a vengeance, because whilst the smaller company rate was up to 300,000, it's now down to 50,000. So it is going to bite. We got 2 years to get organized, but it's there. So that's the story on corporation tax. There is a little bit more help. Not only has he delayed the rate by 2 years, he's also allowed you some extra relief. So companies which making a hair because of COVID or any other reason, doesn't matter what, have made a loss in the year which is going to end on 31st of March 2020, or in the next year, 12 months, those losses at present can only be carried back a year under current rules. But under the new rules he's bringing up, that carryback has been temporarily extended. Extended to what? 2 years, further 2 years. So if you have made a loss in this current year, that loss, before the new rules came in, could only be carried back a year. You can now carry back 3 years. What does that mean? That means if you have paid taxes in the past on the basis of profits, then the losses you made in any 12-month, in this 12-month period, can be carried back to the last 12 months. So the immediately past year, if you have paid any taxes, that can be refunded. And you can go back 3 years. So that is not a bad thing, something we will have to start working on to consider. And this applies, as I said, to losses between 1st of April and 31st of March 22. So a full 2 years, if we incurred losses in our companies, we have the opportunity to carry back those losses. And by carrying back, meaning we can get a refund if we have paid any taxes. So there is a big if there as well. So that's the corporation tax position. What about this other thing which people are getting excited about? When this was announced on the Wednesday, the 3rd of March, people got terribly excited. Excited because the rule says that anybody who invests in plant and machinery in a company, any company rather, let me make that clear, this only applies to companies, not to individuals, not to partnerships, only limited companies. A limited company, a corporation which pays corporation tax, if it invests in plant and machinery, then they're entitled to, and this is, sorry, the period is between April 21, which is coming up 1st of April, to the next 2 years. So encouraging investment in the next 2 years, you will be entitled to a super deduction. And that super deduction got people really excited. Excited because if you spend £100,000 cash to buy a new plant, has to be a new plant, by the way, you could get a deduction against your profits for 130,000. That is that 30% super deduction. So you don't spend 130, but you get a deduction of 130. Now, sounds very good. So if you wanted to, you would invest, you would hold back your investment because the rule says it's only for new plant and machinery which you buy from April 2021. But is it that good? I was excited, and the newspapers were even more excited. But this only applies to what used to be called the main rate pool. The main rate pool was where you had a single asset which you could not claim 100% allowances. You were limited to 18%. Or the pool where you only got a 6% allowance, which was the special rate pool, which was for items, integral features in a building or a long life asset like a lift in the building and things like that. Because they were long life assets, they only gave you a deduction for 6%. Now, those two things, anything which fell into those two categories will qualify for a deduction of 130%. But then there is always 100% allowances always there, known as a annual investment allowance. Annual investment allowance has been with us for a few years now. That was set up to encourage people to do the same thing. Invest in equipment of all sorts. You got 100% deduction. There's a limit at the moment. The limit is £1 million. So if you're spending more than £1 million, you might then not be entitled to the investment allowance, annual investment allowance. Then you might be excited to get the 130% deduction. But for average companies, clients of our size, I think we'll stick and be happy with the annual investment allowance of 100%, because you get a deduction in the year in which the money is spent, 100%. So it just shows, was there a bit of skullduggery there to get people excited? Maybe it was. So I'm not too excited about super deduction, but it's there. If you're a big company and you're paying tax at 25%, you might invest in a big plant, a JCB digger, and claim 135% deduction for it. But for the average client we deal with, I'm not getting excited. So that is the corporation tax position. What about income tax? Has anything changed there? The rates have not changed. We're still onto the same 20% basic rate, and then 40%, and then 45%. But what has changed, and this is where all the talk now is about, the number of people will now get hit by this change. The change is only going to be in the thresholds, the personal allowance, the amount above which people start paying income tax. Now, this has been £2,500, and it's supposed to have gone up every year by the CPI, which is Consumer Prices Index. And this went up, or last December, it was announced that the rate would be going up to 12,570, which it will go up from this April, because that's what was committed. But going forward, this is going to be frozen. So that annual increase in the consumer price index is not going to happen. So what happens then? More people who thought they won't have to pay taxes if their salaries, wages increase with the CPI, will unfortunately now end up paying a little bit of tax. The first 12,570 is still tax-free, so it's only the amount above that where you pay taxes. And this comes in from April 2021, and it is frozen till 5th of April 2026. So this is what people are getting excited about, because along with the personal allowance rate, the threshold for the basic limit up to which you pay tax only at 20% has also been frozen at 37,700. It will remain at that for the next 6 years, or thereabouts, up to 5th of April 2026. And that is the other threshold where people will start feeling the pinch. Because if you earn up to 50,270, you pay tax only at the basic rate, because your first 12,570 is tax-free, and the next 37,500 you pay tax at 20%. So altogether, you could earn up to £50,270 and only pay tax at 20%. Now, this means that anybody who starts earning more than that will then fall in the 40% tax bracket. Again, it's 40% on the amount above 50,270. So that is a change in income tax. No changes in actual rates, but the threshold, the bands have been changed, and a lot of people are claiming they will be hurt by it, or they will have to pay more taxes. But yes, not for another 2 years. Well, no, this one starts now, but it start hurting when the rate doesn't go up. Current year's rate has already gone up by the CPI. The following 2 years, 3-4 years, it is going to be frozen. So that was the income tax rates. Let's go now to VAT. Now, you may remember that just before June or July, the Chancellor actually reduced the rate of VAT to a very comfortable 5%, to the hospitality sector. And the hospitality sector is basically that sector which includes restaurants, hotels, accommodation places, people who organize events, theme parks, zoos, and all that. They were given, or their VAT rate for the services they provide, the goods they sell, was reduced to 5%. Now, you probably never noticed it. Why didn't you notice it? Because most of these places, well, by law, have to give you a price inclusive of VAT. So what had happened was that the businesses themselves kept their charges to the 20% rate, which is what you and I paid when we went out for a meal. But the amount of, in the past, they used to pay 20% of that to HMRC. Now they were only paying 5%. So they gained that 15%, which they kept in their pockets. And they are going to carry on, even though that was supposed to finish on 31st of March, having been extended once, is now been extended again, extended for another 6 months. So a benefit if you're in the hospitality industry, and some of our clients are, those who are still left in the business, this has been extended to 6 months to 30th of September. The rate is 5%. And then he's going to introduce an intermediate rate, which will apply for the next 6 months, 1st of October to 22nd. And that rate is 12.5%. The idea being it's 5% now, gradually put up to 12.5%. And then on 1st of April next year, we're back into the happy land of 20%. Happy from the exchequer's point of view, because they will get the full 20% which you and I pay on the bill. And sadly, for the hospitality industry, they will lose the money they have been pocketing. So that is the VAT rate. Now, there's another change, as you know, which I need to refer to on VAT. And this is something which is going to come in a little bit later, but something we ought to be aware of. Again, introduced in this budget. And this is the sanctions for late payment. By late payment of the VAT on the or submitting a late VAT return. Now, all these years we've had something called the currently we have the default surcharge regime. There's a default surcharge that if you're late for twice in a 12-month period, you get charged interest, which keeps gradually going up from 5% to 10% to 15%. That is going to change, but it's going to change from April 2022, not straight away, not this year, in 12 months' time. What are they going to do now? No penalty if you pay the VAT amount due to HMRC within 15 days of the due date. Now, I think that means it's going to be 15 days from the 12th of the month. Because currently, if you file a VAT return electronically by the 7th, then the amount that is automatically withdrawn from your account by direct debit is on the 12th of the month. So and we'll know this when the legislation actually comes out, I'm hoping that's what it will be. So they'll allow you another 15 days to make that payment, and there'll be no penalties. So when do the penalties start biting? The penalties will start biting if you have not paid for 15 days and you go up to the 30 days. At that point, they will add 2% on the amount outstanding, the amount of VAT which should have been paid, the amount of VAT you did not pay, 2%. But that's not the end of the story, because if you haven't paid in 30 days, that same thing goes up to 4%. Thankfully, it doesn't go up more than 4%. The draconian regime that we've had was actually going up to 15%. So at present, they're only talking of 4% if you miss the deadline by 30 days. So that's coming from 1st of April 2022. Now, you will remember that apart from reducing the rate of 5%, the Chancellor also earlier in the COVID days, allowed you to defer your VAT that was due to be paid between March and 20, was it the 20th of March and the 30th of June? Any VAT which was due to be paid in that period, you were allowed to defer. And defer until what date? 31st of March 2021, which is coming up. End of this month, all that amount of VAT which was deferred was going to be, had to be paid. But generous man that he is, they've allowed that to be deferred. This can now be spread by a maximum of 11 payments, interest-free, from now onwards. But you have to act fast. You actually have to apply for this. Apply online, and it's got to be done before 21st of June. I would not leave it till the 21st of June. I would get online now, because as the months go by, that 11-month time limit gets lesser and lesser. Because when you apply now, you can apply to pay it over 2 installments or up to 11 installments. Those installments are going to get less and less because they want the whole thing cleared within the next 12 months. So get on this thing now is my advice, and get the maximum 11 months if you want to. The longer you leave it, the less time you'll have, and the fewer payments you will be allowed to make. So if you want a full 11 payments, go online now and do it. Unfortunately, your accountants, we cannot do it. Even though they might be your registered agents for VAT, it's got to be done by the company, by the taxpayer. I am told it's a very simple process. That is, once you can get onto the portal, go on it and get it done. The sooner, the better. And now, as far as this amount deferred is concerned, there is a penalty. If you haven't applied to defer it by 21st of June rather, and you don't pay it, they'll automatically charge you 5%. So if you haven't applied, the conditions are if you haven't applied to defer it and you have not made the payment, you've slept through this time, you will end up with another 5%, which is fair enough. So the message here is, please get on it, the online portal, and apply for that deferment to be spread over the next 11 months if you want to. So that's the VAT on the payments which were deferred last year. I now jump on to something else which has been causing a lot of stir. All those who are hoping to buy properties and were rushing to exchange things by the end of this month, because the deferral or the nil rate band of stamp duty on residential property up to £500,000 was going to expire. That was going to expire this March, and there's been a lot of activity with solicitors trying to get these properties completions done, because the stamp duty on those residential properties, the nil rate band was going to disappear. Is it going to disappear? You obviously heard it isn't. It's been extended to 30th of June. So we now have up to 30th of June to make use of this nil rate band. The nil rate band of 500,000 will expire on 30th of June. And then he's got a new nil rate band. So to soften the blow, he's also introduced another nil rate band, the 250,000. So up to the first $250,000 will not attract any stamp duty. This is for somebody buying as for just one property for residential use and are UK residents. Nil rate of stamp duty up to £250,000 after from 1st of July to September. After that, I'm afraid it's back to the original nil rail band of £125,000. So you're never paid, well, you haven't been paying stamp duty on the first £125,000, and then there are bands of, then you paid stamp duty on the amount above that. So that is another little giveaway which has come in this budget. Carrying on then to all the other giveaways to do with COVID-19. The VAT deferral, the reduction rate, the stamp duty extension to the limit, and now something else, a recovery loan. We've had CBILS, we've had bounce back loans. From 6th of April, he's introducing another one, a recovery loan, a loan to help people recover from the ravages of COVID-19, from having been closed, from shops having been closed, from restaurants having been closed. Those who have been closed, they're going to be able to borrow some more money to recover, right? That is the way it's been set up, is the government will guarantee 80% of the loan. Now, he did mention in his speech to the House that he had the main four main banks, as they're known, Barclays, NatWest, HSBC, and Lloyds, have all agreed to provide these loans. But I see some difficulties here, to be honest, because whilst the government is happy to guarantee your 80%, the 20% risk still lies with the bank. And whilst the government would like them to cooperate and lend, the banks are going to be looking at your eligibility, whether you're able to afford extra funding, whether you can afford the rates they're going to offer. And we don't know what rates this is going to be at, by the way. So it's there. Let's look out for it and let's see what happens. Once again, similar to the previous rules, no personal guarantees. And this loans, by the way, are from £25,000 to 10 million. If you're going to borrow more than £250,000, you'll have to give personal guarantees. And these loans are available even to those who have had CBILS or the bounce back loans. But like I said, it's up to the banks because they have to secure their 20%. They can't ask for personal guarantees, which makes it more difficult and makes them more cautious, which makes them want to look at your circumstances and only then give you the money. So it's there. Let's see how it works out. Now, the terms are basically the loans you can have up to 6 years. And it's available in overdrafts as well and invoice finance. So on overdraft and invoice finance, unfortunately, it's only for 3 years. But again, like I said, better than nothing. So if you're desperate for a loan, a recovery loan, ask your bank for the recovery loan scheme. And maybe you can even have the overdraft guaranteed by the government for 80%. And no personal guarantees are required, but you could offer to give a personal guarantee for the 20% and get the money. £25,000 up to 10 million. So that is the new loan scheme. And of course, then there is always the evergreen, the furlough scheme, the scheme that came in a year ago, which came all of a sudden, possibly not completely well thought through, but it served the purpose and got a lot of companies off the hook because they were able to fund or pay the employees with the aid of the government funding. So that furlough scheme was supposed to come to an end in April. It had been extended many times, but it's been extended one more time up to 30th of September. Conditions: it applies to anybody who has been employed, and you must have been employed on the night before the budget to qualify. This is if you had taken on anybody new, they would only qualify if they've actually been included in the payroll or the RTI submission made prior to the midnight before the budget day, which is 2nd of March. So once they're on your system, they're eligible for it from 1st of May. This is, I think, version 4, if you like, of furlough, starting from 1st of May. It will go up to September 2021. 80% is what employees will have to receive all the way for those hours they have not worked. So if they've been working normally, you pay them the normal wages. If you put them on furlough, for the hours on furlough, you pay them 80% and you can claim for 80%. That 80% will be fully covered from May up to 30th of June. That means as an employer, you pay 80%, you claim 80%, no contribution. You still have to buy, when I say no contribution, I meant you still have to pay the national insurance and the pension of the employee. But as far as the basic wages are concerned, you do not have to make any contribution till 30th of June. After 30th of June, I'm afraid the scene changes. The scene changes because you have to make contributions. It's 10% contribution which the employer will make. The employee will still get 80%. You will be able to claim 70% from the government as furlough. And that is, there's a cap, obviously. Whereas up to June, you could claim 2,500. You will only be able to claim 2,187.50 pence for any furlough payments you make in July. That gets down to 60% for the months of August and the month of September. So for the last 2 months, the intention being to gradually do away with furlough, we'll only be able to claim 60%, but you have to pay your employee 80%. So you have to fund the 20% in September and August and 10% in July. Up to June, you claim 80%, you pay 80%. So that is the revised Mark IV of the furlough scheme. Now, this is quite interesting. This is a grant, not a loan. We've had a recovery loan. We now have a recovery grant. Who is this available to? Non-essential retail businesses. So non-essential retail businesses, which have been closed during this last lockdown, are being given £6,000 per premises. No questions asked. £6,000 will come from your local authority into your bank account to help you open up your business. If you're in hospitality, accommodation, leisure, personal care, gym, and this is where our restaurant clients are going to be quite excited, they will get £18,000. £18,000 again per premises. So £18,000 to get you back into the game, to restart after having been closed. Grants, not repayable, but remember one thing about grants. They are taxable. Don't think they're not taxable. And they have to be included in your accounts. Now, I'm going to mention this here because it doesn't matter when you get this grant, you will become taxable on them on the 3rd of March. I make this point because this has come up as of last year as well. The actual amount is not taxable when you received it, but it's taxable when it was announced, when it became available. So because these grants were announced by the Chancellor on the 3rd of March, they will have to be in your accounts if you have a 31st March year end, even if the money doesn't come into your bank account till the 1st of April. So bear that in mind. That's something which people have got caught up with this year. So that's the grant. What were business rates? We have had a 12 months moratorium, no rent, no business rates paid in some businesses. The eligible retail, hospitality, and leisure businesses is what I'm talking about. And small office and small businesses have not paid any rates. The new rateable year starts from 1st of April. So we were receiving a lot of queries about what's going to happen next year. Of course, we couldn't answer them, and nobody could answer them. Not even your local authority could give you an answer because the Chancellor had not said anything. But at the budget on Wednesday, he did say that we will have 100%, these eligible businesses only, will have 100% relief until 30th of June. So the first 3 months of this current rateable year, you have 100% relief. And then after that, it goes down to 66%. So 2/3 relief. So you'll only pay 1/3 of your rates if you are in one of these eligible categories, which is retail, hospitality, and leisure. So another good news, if you like. I will cover this very quickly because I know it doesn't apply to a lot of people on this call, but this is a self-employment income support. We've had 3 portions of this. A 4th grant is coming up to cover the period from February to April. The conditions are self-employed people are also entitled to a maximum of £7,500, but it is dependent upon 80%, and you will appreciate where the 80% comes from. It's 80% of 3 months of average profits over 4 years. When it first came in, they were looking at last 3 years. Now another year has gone by, so you can look at your last 4 years, find your average profit, and if it's less than, and you'll get 80% of that, but the cap is 7,500. You won't get more than 7,500 pounds. But there's now a new condition. And the new condition says you are only entitled to claim this, the 4th grant, if your profits fell in this current year between February and April, which I assume with the lockdown will apply to most of these self-employed people, but that is a condition they have to be careful of. And this will be available in late April because it covers a period up to April. And it will also now be available to new businesses. When this was announced last year, the new businesses got caught out. Those who had started after April got caught out because they were not included. But now, because they were in business last year, they will be able to get the grant as part of the rules under the 4th grant. Then we go on to what is coming up next, which is the 5th and final grant. Final in the hope that COVID will have been sorted out by September, if not before, but you will still if you're self-employed, you'll still get a grant, but the conditions have now changed. It is now going to be based upon your turnover. If your turnover has fallen by more than 30%, remember under the 4th grant, your profits had to have fallen between February and April this year. Profits. Now, if your turnover has fallen by 30% or more, then you can still claim your 80%, maximum 7,500. If your turnover has fallen by less than 30%, then you will get 30% maximum. the maximum cap being 2,850. Like I said, this doesn't apply to a lot of you, but I just bring it up here because if you know somebody who wants to help and advice on this, please let them come and talk to us. So those were the changes. I now come to the final portion, which is where there have been no changes at all. Capital gains tax is where all the hoo-ha was before the budget. People were saying he's going to have to put up capital gains tax rates. It's going to become equivalent to income tax rates. They're going to do away with what used to be called entrepreneur's allowance, as now the business asset disposal relief. But no, nothing, no changes at all. Everything remains as it was. Annual exemption is frozen like everything else, and that is the only minor change. On inheritance tax, likewise, absolutely nothing has changed. The threshold remains at 325, and once again, it's frozen. But that is it. That are the nuts and bolts of this budget. I have gone through everything I feel applies to small businesses. So I will stop here and I will now call upon Agnes to come in and let me know if there are any questions. If there are any questions, I can now answer them and take up.
Thank you, Virish. So if, as Virish said, if anyone got any questions, please just submit them now in the Q&A box. And of course, if you got any questions that you want to ask privately, that's completely fine. Please just get in touch with us after the webinar. And so it seems that we don't have any questions, Virish.
Oh, so I've answered, I've explained everything so well that nobody's got any questions. I'm sure a few questions will. Yeah. Sorry, I'm just rubbing my. If there are any questions, they will come up. If you think about it, please do get in touch. Happy to help in any way we can. It's there. It wasn't as draconian as we thought. Things are possibly looking up. And if I'm allowed to say, give my own personal opinion, I would be very surprised if that rate of 25% does even go up. Why do I make that comment? I'm a cynical person as far as taxes are concerned, as far as politics are concerned. And you know what? Before that rate goes up, there's an election on the way. And a good chance that a tactical chancellor would get up and say, you know what? We're not going to put that rate up to 25%. What do you think he's going to do? Go back to 19% or reduce it? That will score them some points. So all these things which have been put back by a couple of years are there in case they need to pull them in. I think it won't happen. But then again, neither does the chancellor. So he's hedged his bets, and I admire him for that. And I think that's good politics and good economics as well, because it gives people next 2 years to get their houses in order, to get their business in order, to work on them, start making the money, and enjoy the fruits of the giveaways he's given you. And before the higher taxes start biting, I think things will look a little bit better. Maybe we'll even be happy to pay 25% if you're making all that money and things are back to normal. So I'll leave you with that thought. It's been interesting discussing this. I hope you found it enjoyable. I hope you found it interesting. So with those words, I'd like to thank Agnes for moderating this session, for keeping an eye on the questions, and as usual, being a great help. Thank you, everybody. I'll see you at our next webinar. Thank you.